We're jumping straight into Amphenol today.
Yeah.
Everyone is watching the price action, but the real story is the massive disconnect between a record earnings beat and the market's immediate reaction.
Right.
I mean, we were talking about a company that just posted record Q4 sales of $6.4 billion.
Incredible numbers.
They beat Wall Street with an adjusted EPS of 97 cents. Objectively fantastic, but, and here's the hook, the stock takes a sharp 12.20% nosedive. So the big question is, why? Why did great news lead to such a big sell-off?
Exactly. You're tuned into the Easy Money Show where we make sense of the market's biggest moves. I'm glad you're with us.
It's good to be here.
And, it feels like we're seeing this more and more, this whole good news is bad news thing.
Totally.
It's a textbook case of market psychology just slamming into fundamental data. It really separates the traders from the long-term investors, and we got to figure out which side this company falls on.
Well, before we get into the nuts and bolts of that drop, I just want to say, if you want to stay ahead of these kinds of market moves, make sure you subscribe and hit that like button.
Yeah, please do.
And I really want to hear from you on this one. Drop a comment below and let us know. Do you think the market totally overreacted here, or was this correction overdue?
Good question.
Okay, let's unpack this. And I think to understand the drop, we have to first understand what we're even buying.
That's the perfect place to start, because you look at the ticker and you might just see electronic components, which, let's be honest, sounds incredibly boring.
Right.
So let's simplify what Amphenol actually does. They're the second largest connector and sensor manufacturer in the world. But don't think of them as just making, plugs in wires you'd find at the hardware store.
No, not at all.
Think of their products as the nervous system for all of modern electronics.
The nervous system? That's a great analogy, probably the most accurate way to put it. But let's get specific on why that's so important, because I think a lot of people just assume a wire is a wire.
And that's the dangerous assumption. I mean, think about where these things have to work. You've got a massive data center running the latest AI model, an electric vehicle managing huge amounts of power from the battery, or a fighter jet's avionics. None of it works without the interconnects that move data and power from point A to point B.
So if the connector fails, the whole system just dies.
Exactly. Your $10 connector melts and your $50,000 GPU cluster goes offline. Or even worse, your EV just shuts down on the highway. Amphenol provides that critical high-stakes infrastructure.
Okay, so when we talk about the bull case, we're not just betting on some parts maker. We're betting on the actual physical plumbing of the future economy.
You got it.
But here's where I have to play devil's advocate. We're talking about cables, sensors. Why is this a high-margin business? Why aren't they getting wiped out by generic manufacturers who can make it for half the price?
That is the key question, and the answer is right there in the financials. This is not a commodity business. It's precision engineering.
Yeah.
I love a Fortress balance sheet, and Amphenol has one. Their current ratio is sitting pretty at 2.07 times.
So they have over twice as many liquid assets as short-term debt. They are not going broke.
Not even close. They're incredibly liquid.
Yeah.
But the number that really blew me away, and this gets to your question about margins, is the return on equity, or ROE.
Okay.
It's a massive 34.65%.
34%. Wait, for a hardware company, that seems incredibly high.
It is exceptionally high. Just for context, in the hardware space, you're usually happy to see ROE in the teens, maybe low 20s if they're having a great year.
Because it's so capital intensive. Factories, material.
Right. All that CapEx. To see a hardware company pushing 35%, that's like software level efficiency.
So just to be clear for everyone listening, ROE is basically how good a company is at making a profit from every dollar shareholders have put in.
Precisely. It tells me that management is just incredibly efficient with their capital. They don't waste money. And that efficiency is what powers the whole AI tailwind argument.
Okay, so let's connect those dots.
The whole bull case really hinges on this AI infrastructure build-out.
Yeah.
We hear about NVIDIA chips and GPUs constantly, but those chips need to talk to each other.
Right. It's not one chip anymore. It's clusters of thousands of them.
And that changes the physics of the data center. You're running these massive models.
Yeah.
You absolutely cannot have a bottleneck in your cabling. You need these high-speed, low-latency connectors that can handle insane heat and power loads.
And Amphenol makes those high-end connectors.
They're a prime supplier. If you cheap out on the connector, you risk melting your entire system.
So the risk of failure is just too high to go with the generic brand. That creates a natural barrier.
And that gets us to the concept of switching costs.
Huh?
This is the secret sauce. This is the real moat.
Explain that.
Imagine you're an engineer at a car company designing a new EV, or you're an architect for a data center. You spend months, maybe years, designing your whole system around a specific interconnect from Amphenol. Once they're designed in, it becomes incredibly expensive and just super risky to switch to a different supplier.
Because you'd have to rip out the entire nervous system.
You'd have to re-engineer the product, retest everything for safety and reliability, redo your supply chain. It's not like swapping out printer paper.
It's more like trying to change the foundation of a house after you've already built the walls.
Exactly. It creates very, very sticky revenue.
Yeah.
And on top of that, they're incredibly diversified.
Yeah.
They are not a one-trick pony just riding the AI boom.
Right. That's interesting because usually when we talk about AI plays, it's pure tech. But these guys are in automotive, broadband, aviation, military, mobile.
And this is key because industries are cyclical. If the mobile phone market has a slow year, maybe military and aerospace picks up. That diversification helps smooth out their revenue.
And we saw that in the last report.
We did. That record Q4 we mentioned. That growth was driven by this exact thing, diversification, plus that accelerating demand from AI. They're proving they can grow even when some individual markets are down. They are firing on multiple cylinders.
Okay, so let me just recap the bull case. We have a company with a massive moat, from high switching costs, super sticky customers, record sales, and efficiency numbers that look like a software company's.
It sounds perfect. Bulletproof.
It does. Which brings us right back to the elephant in the room. If everything is so great, why on earth did the stock tank 12%? Let's break that down.
This is the bear case. And it really comes down to one simple phrase. Priced for perfection.
I hear that all the time, but what does it actually mean for someone holding the stock?
It means that the market has already factored in years of flawless execution. Investors are paying a price today for growth they expect to see way down the line.
So when expectations are that high,
Even a good report can look bad because it wasn't absolutely unbelievably perfect.
and looking at the valuation numbers, Amphenol is definitely trading at a premium. What are we looking at?
They're trading at a normalized PE ratio of roughly 49.99. Let's just call it 50 times earnings.
50 times earnings for an industrial manufacturer. That sounds incredibly expensive.
It's a luxury price tag. I mean, for some context, look at their peers. TE Connectivity is trading around 23 times earnings. Sanmina is down around 10.
So you're paying double, sometimes triple the multiple for Amphenol.
You are. And that's the danger zone. When you pay 50 times earnings, you're saying, I believe this company is going to grow way faster than everyone else for a very long time. The market has already priced that in. So where's the upside?
And that explains the drop. It wasn't about Q4, which was great. It was about the future.
Exactly. The drop was triggered because their guidance for Q1 2026 didn't exceed the market's sky-high expectations. They beat earnings, but they didn't promise to beat them by enough next quarter.
The dreaded guidance issue. And this brings up the risk of valuation compression. This is what keeps value investors up at night.
It really is.
Can you just quickly explain that concept?
Sure. Valuation compression is what happens when the market decides a company is no longer a hyper-growth story, but maybe just a good story. If earnings growth slows down just a little bit, it doesn't even stop, just slows, that high PE multiple can shrink fast.
So if the market decides Amphenol is only worth, say, 30 times earnings instead of 50.
Wow, the stock price can fall hard, even if the company is still making more money than it did the year before.
Wow. So you can lose money not because the business failed, but because the hype just evaporated.
That's it. Precisely. The earnings go up, but the stock price goes down because the multiple contracts. That's the risk you take buying at 50 times earnings.
It's a scary thought. And we have to remember, despite all the AI hype, this is still an industrial company. It's exposed to economic cycles.
Absolutely. If we hit a global recession, people buy fewer cars. Airlines delay plane orders. Telecoms pause their spending.
And Amphenol fuels all of that. They are not immune to the macro picture. And you see this tension in the analyst estimates. You'll see one firm like Morningstar with a fair value estimate significantly higher, around $612.
Right.
But then other metrics just scream that it's expensive relative to its peers. There's a real disconnect.
And that disconnect is what creates the high-risk, high-reward scenario here. The bulls see the AI boom, justifying the price. The bears see a bubble waiting to pop.
Okay, so we've got a clear divide. Bulls see a compounder owning the nervous system of the AI revolution. Bears see an overpriced industrial that's run too far too fast.
Hmm.
So if you're listening to this trying to figure out what to do next, what are the specific signals we should be watching over the next, say, 30 to 90 days?
Well, the most immediate thing is Q1 2026. We're looking toward late April for that earnings report. That's the next big catalyst.
And what are we looking for in that report? Is it just the top-line revenue number again?
It's revenue for sure, but I'm looking deeper. I'm watching the integration of their recent acquisitions.
Okay.
Amphenol has been buying smaller companies to get new tech. The key question is, are those acquisitions contributing to the bottom line like they promised?
You want to see if they're accretive.
Exactly. Are they adding profit right away, or are they just adding revenue while dragging down the margins? If they show these new assets are profitable, it validates the strategy. If not, the market will punish them again.
Got it. So watch acquisition integration in April. What about outside of the financial reports?
Outside of financials, I'm watching industry events. We're in conference season. You've got Mobile World Congress, post-CES updates.
But why do those matter for the stock? Isn't that all just marketing?
It's marketing that builds the narrative. And remember, the narrative is what's supporting that 50 PE multiple.
Ah, okay.
So I'm looking for specific announcements about new connectors for AI hardware and for EVs. If Amphenol gets on stage and reveals some new proprietary connector that solves a huge heat or latency problem for the next generation of data centers, that reinforces the moat argument.
That makes sense. It changes the story from industrial parts maker to tech innovator.
And if they're a tech innovator, that 50 PE feels a lot safer.
Right. I'd also add a macro factor to watch. Sector rotation.
Break that down for us.
Money moves in waves, right?
Yeah.
Sometimes investors love high-risk growth stocks like tech. Other times, they get scared and rotate into safer value or industrial stocks. Amphenol is weird because it's an industrial company with a tech valuation.
So it can get hit from both sides.
Or benefit from both. If interest rates stabilize, investors might move back into industrial hardware, which helps Amphenol. But if the whole AI trade starts to cool off, if people get tired of NVIDIA and Microsoft, Amphenol could get dragged down with them just by association.
So it has a high beta to the AI theme.
A very high beta. If the AI sector sneezes, Amphenol could catch a bad cold.
Okay, so we have the April earnings, product announcements, and broader sector rotation. That's a pretty clear roadmap.
I think so. It takes out the guesswork and gives you actual data points to track.
So let's bring it all home. We've looked at the record numbers, the big drop, the amazing balance sheet, and that nosebleed valuation.
It's a really fascinating setup. You don't often see a company this good, trading this rich, take a hit like that.
You really don't. Here's the final lowdown. You're looking at a trade-off. You're paying a luxury price, that 50 times PE, for what is, frankly, a luxury company. You're getting a 34% ROE, a great management team, and huge exposure to the biggest trend in tech. But you're paying a massive premium for it.
It's the classic quality rarely goes on sale argument.
It is, but that price tag, it demands perfection.
And that leads to my final thought for everyone to chew on. We saw that 12% drop. Is that a warning sign? A signal that the valuation is just too stretched and the rubber band is about to snap back? Or is this a rare blue chip discount? Is this one of those moments you look back on in a few years and say, I can't believe I got a chance to buy the nervous system of the AI economy at a 12% discount?
That is the multi-billion-dollar question.
Yeah.
And right now, the market hasn't decided.
It hasn't. And I think the answer really depends on your timeline and how much you believe in the AI build-out. Thanks for joining us on the Easy Money Show. Keep your eyes on the data, and we'll see you next time.